Hello, my name is Nathan Lead. I'm a senior analyst in the Morgans research team. I cover the infrastructure sector. Early this week, Transurban put out an update on its distribution and its traffic. I'm going to cover off on those at a higher level, and then I'll also talk about my investment views on the stock. So just on traffic, early this week, Transurban put out an update on its traffic. It showed how traffic had started to recover from the lows that it saw in the early April period, but traffic is still down materially on the previous corresponding period. The latest weekly data point in June they showed had overall portfolio traffic down 21% on the previous corresponding period, and that was compared to about a 50% decline or mid-50% decline in the first half of April. Interesting to see that trucks remain way more resilient than cars during this period. That's important because trucks generally have about 3 times the toll of a car. So very important to see the resilience of that particular revenue stream. So trucks down about 5% overall in the latest data point. And that's compared to that 21% growth or decline that we saw overall for the portfolio. Interesting to see also that Sydney trucks, we're actually seeing some positive growth coming through in the latest data points. That's a good thing to see. To me, the question still remains, though, even after seeing that recovery coming through, the question still remains, how long will it take to recover back to steady state levels? And then secondly, will there be any long-term structural or permanent impacts coming through during this COVID-19 period? I think the impacts of working from home, from increased commercial home deliveries, from potential modal choice away from public transport into private travel, increased unemployment, decreased population growth, all these things could have a longer-term lingering impact on traffic volumes. And if it causes a sort of a permanent decline or a reduction compared to where we were before, that puts under pressure its credit metrics and then calls into question about whether there may be a capital raising down the track to restore the balance sheet to where it formerly was. So just something that we need to watch for there. In terms of the distribution, Transurban has put out an estimate, effectively guidance for the second half 20 distribution at 16 cents. Now that was ahead of what consensus was expecting at around about 13 cents. I was expecting around about 14 cents per share. So a positive outcome on that front, but certainly well down on what it was paying in the first half and what it was originally expecting to pay this year. It hasn't provided any guidance for FY21, but has a policy now of paying out from its free cash, excluding capital releases, which are effectively borrowings from its asset companies that it flushes up to its corporate level to pay out to investors. So no longer will those be included in the available distributable cash flow. I've upgraded my short-term distribution forecasts, but really the reality is that the distribution depends on the outturn of traffic, and that really depends on that recovery coming through next year. I'm targeting a distribution of 37.5 cents for FY21 and then a rapid recovery back upwards to 59 cents in FY22. There's 2 interesting things on this distribution front. So the first thing is that the distribution over the next 12 months I think is going to be quite constrained, so probably only about 32 cents per share. So that's the distribution for the second half of 20 and first half 21. So that means Transurban really over the next 12 months is trading on only around about 2%. So that's an important number to know for an income-orientated investor. Obviously that will improve very rapidly as they recover in terms of traffic, but just over the next 12 months quite constrained on that income yield. The second thing is that consensus was expecting around about 47 cents per share for FY21. I think that is far too high. I think consensus previously was baking in the paying out of those capital releases. I don't think consensus correctly captures how much additional interest costs are going to be paid by the business because of the additional working capital facilities they had to put in place during the COVID period to provide liquidity. And also because they've got a number of development projects that will come online in early FY21, and as soon as they come online, they start to pay the interest costs related to those, the interest costs related to the construction funding that were previously capitalised. Also, there is lagged payments of distributions out of non-controlled entities. So those entities that were being affected during the fourth quarter of this financial year, the distribution will actually be impacted in the first quarter of next year into Transurban's free cash flow calculation. So that will actually cause a drag in terms of the cash they can pay out in that period. So just a couple of things to think about. And I think that's actually going to cause consensus downgrades on the distribution outlook for Transurban going forwards. My investment view, look, forecast changes and valuation roll forward. See my target price lift about 15 cents. I'm now at $13.67. I'm still well below where the share price is trading. It has had an amazing recovery since the sort of the heat of the impacts from COVID-19. At some points it's been trading at the level it was before COVID actually hit, even though we've still got those unanswered questions to do with the traffic coming through. So I think the stock has run too hard for the risk that's actually facing at the moment. I think the returns are actually quite constrained. Hence, I've got a hold rating on the stock, and I'd also suggest if you're overweight on this stock in your portfolio, really consider actually taking some profits on it at the moment. I'd be a lot more bullish on this stock if we can see it more back down into the low 13s, high $12 sort of range, which is not inconceivable if there was a sort of a second wave of COVID-19 coming through that panics the market once again. Thank you very much.